News out of Iran is still driving the market. All week it was back and forth. Monday, the US said we're 95% of the way to a deal. Tuesday, there were new strikes. And then Wednesday, things kind of moved back toward negotiations again. Last night, reports came out that negotiators had reached basically a 60-day memo of understanding. And that was basically to agree to open the Strait of Hormuz, extend the ceasefire another 60 days, and start nuclear negotiations. Markets did rally on that news, and mortgage bonds had their best day in weeks, and they were up again this morning. Overall, good improvement from last week anyways on the rate front. And then the U.S. actually denied the deal was real, which kind of took some of the air out of things. So we're just, I guess, cautiously optimistic for now. But this thing's been a roller coaster, and it's not done. It seems like everything happens over the weekends. But here's what matters for rates. Oil prices are still above $90 a barrel, which is lower than last week. But as long as the strait's closed, that's basically going to keep a cap on how much improvement we can see. If a real deal does get done and start moving oil again, then rates could be a quarter to half a point better within a few weeks. And that's obviously would be a pretty big difference. And it's worth watching. On the economic front, it was a heavy week, and most of it really pointed in the same direction. GDP for the first quarter came in weaker than expected. The headline number already looked pretty bad, but when you take out AI and data center investment, it would have been a lot uglier. Basically, the rest of the economy outside of tech infrastructure is struggling. Durable goods looked really strong on the surface, but it was entirely jumbo aircraft orders. You can strip those out in the core reading, and that number was actually down 1%, and that was well below estimates. Saving rates have continued to drop, and on jobless claims, they were up a little, but still kind of low numbers overall. But continuing claims are creeping up, and I'm happy to talk to you about kind of the gig economy and how that plays a role. But the economy's already been slowing before the oil hit, and these numbers just confirm that. PCE, which is the Fed's favorite measure of inflation, came in at 0.4%, and that's month over month. Higher than we wanted, but it came in below expectations, and core was a touch light, or I should say. These numbers are really distorted from the government shutdown, where they basically just plugged a zero in since they didn't measure anything, and that inflated the shelter component. Keeping in mind that the incoming Fed chair, Kevin Warsh, he's talked about shifting to a different inflation measure, like from PCE altogether once he does get confirmed, which is done now. June meeting is still the target for the first possible Fed cut. Case-Shiller, as far as housing news goes, showed national home values up about 1% year over year. And the Fannie Mae Economist Survey, that put the 5-year appreciation outlook at 14% nationwide. That's $70,000 on a $500,000 home. Useful context for buyers you might know who are sitting on the fence. Rents do continue to fall year over year, actually down 1.5%, which should help, at least I should say helping shelter inflation come down in the future reports that we get. But one item that I do want to flag for clients, there was an Urban Institute study, and they found that FHA zero-down mortgages for first-time buyers with scores over 700 would actually raise default rates by only 12 basis points, which is practically nothing, and they say it's statistically insignificant. Nothing's been implemented yet, but if that product gets greenlit, then it does open the door for a lot of renters who have the income and the credit, but just can't save for a down payment. Something to watch. But next week's Jobs Week, I'm going to have job openings for you, ADP numbers, the Fed Beige Book, Challenger job cuts, and the BLS report on Friday, which has been completely unreliable. But I'll see you next Friday to let you know how everything comes out.